Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. And today we're breaking down OMAH, the Omaha, as better known, Berkshire Hathaway Income ETF. The question is the powerhouse in dividends? Well, this is the one that we all talked about was going to come out with a 15% targeted return on distributions that everyone thought was going to be the big powerhouse across the board. Well, we're going to break it down. We're going to do our back test. We're going to take a look at three different versions. Basically, I call it the retirement version, where you take all the income, put it in your pocket, go live, enjoy life. Or we're going to do a 50-50 drip and a 100% drip. We're going to find out where this fund happens. And we're also going to take a look at the return of capital risk and the return of capital across the board. Let's dig into it today. We got a lot of information to cover. Well, we got to do the formal announcement is that the past performance does not guarantee future results. The information provided in this video is for educational and informational purposes only. I am not a financial advisor, nor is this financial advice. If you need to find out financial advice, always contact a professional. So let's take a look at what we did here. We established an all-in baseline. I use this a lot with different funds that we use an initial investment of $525,000. It's just a number that I found that a lot of retirees have, kind of the magic number that most retirees will have in a particular fund. So I just wanted to see if you took that entire amount and put it into a particular fund, how does it work? Now, this fund started in March of 2025. So we're just actually doing this video. We're a little bit behind, but this thing could be just almost literally 1 year old. The share price started off at $19.60. So if we had the $525,000 invested into just this fund, we would have a 26,786 total shares purchased. Now the market volatility that has impacted the share price. When this first started off at $19.60 back in March, we have some adjustments that have gone down. It's gone down 7.19% decline from 1960 down to 1819. Now, this is the first part that everyone will sit back and say, oh my God, NAV erosion. Well, truthfully, guys, NAV erosion is when the fund is paying out more distributions than actually it's generating. That's where you start cutting into the NAV, the net asset value of the fund. What we're seeing with this fund and the way it's built, they're basically setting up their distributions by a percentage of the price of the shares of the stock. So the fun of it's not built for NAV erosion. It's not built for that. What you're having is market volatility, market driving the price. So really it comes to the underlying stocks. How well are they doing into the operation so that they can sell their calls and generate the income that's needed. And when you see a fund that's only a year old, there's a combination of things that happen. One is the excitement of the fund. When this thing was being announced, the advertising, the promotions, and the excitement out in the field was huge that they thought this was going to be the greatest piece ever made. And then you got to get over the excitement that ever starts producing what it needs to do. And VistaShares advertising a 15% target, which a lot of people were like, that's crazy. That's big nunners. So these are things you had to work with. And so what we're seeing now is the fund is slowly developing and kind of what we call finding its own, hitting its bottom, hitting its where its settling down point is. Now the monthly distributions, we've seen this, and I just pulled a few select ones off, but we're seeing 25 cents, 23 cents, 24, 23. And like I said, I read the perspective totally through on this one. I personally invested into it, but I basically sat down, read the perspective, and saw how they're coming up with their target. So I believe the number, don't hold me to this one to a T, but I believe it's 1.25% of the share price on that month that they set up the distributions on. So the thing is designed by the price of the shares is going to pay out that distribution, which is again keeps control over that NAV situation. But what you want is your underlying stocks to perform. So you raise the price of the funds to keep everything rolling forward. But the market volatility that we've had over the past 12 months has controlled this. So let's take a look a little deeper into this. And you can see that the fund has done well in the assets, $685 million over a 12-month period. The expense ratio, 0.95, high for for this type of fund, but that's what they're getting. 38 million shares outstanding. They've paid a 16% dividend yield, so they have beat their target number that they said they were going to do. Okay, this was targeted 15. And what is it's not a guarantee, but it's their target. They're going to achieve a 15% dividend yield over the 12-month period. And this is going to give you the next reason why I always preach about total returns. Because the dividend yield is one thing, but your total return is what really matters. So getting 16%, and I know there's people out there because I've personally talked to them, either on the phone, through email, chat boxes. We've talked about this, and it comes back with, I'm making 16% on Omaha. I'm perfect. Everything's great. But what they miss out on is their total return. When we look at the total return of the fund over the past 1 year, it's 6.87%. Since inception, 5.97%. Year to date, so 4 months into this, 0.14%. So what's happening is you're losing more value of the fund that the dividends are not making up for. Okay, like we said, we lost 7 percentage points off the price of the value. That comes off of your basically part of your dividends as your total return. So the fund looks good on the targeting. It's doing that, but it's got to look at the holdings, the 87 different holdings that they have. What are those things doing? So let's take a look at the holdings that they currently have. Now, financials, 32.59%. Consumer staples, 17%. Technology is down to 15%. Okay, we're looking at energy, consumer discretion, healthcare, communication services, and a big chunk for other. When we look at the list, well, I can tell you guys, a lot of this stuff is very, very similar to what is in the Berkshire Hathaway portfolio. Now you see that we own 9.7% of the fund is into the Berkshire Hathaway. Another one, 1% into Apple, 9.76%. Number 3 is American Express. We see the Chevron oil is going to play with that one. Coca-Cola, Kroger. So they have a lot of quality funds in here. But we, take a look at each one of these, and it's a balanced fund. But you got to take a look and say, what are we getting from each one of these? What's happening in the banking industry? Because that's making up 32% of your the portfolio in the financials. So when you look at this going deeper, is this a diversified fund? Yeah, very well diversified. Is it hitting the big stuff as in technology? No. But is it also looking future down the road that financials are going to be the big piece or not? And that's what we're really talking about right now. Is this a long haul run? Is this a short term run? So let's take a look at how it's really come about after seeing all the information behind the scenes. So the full reinvestment, or what I always like to say is, this is the pre-retirement people. This is the ones that want to build everything you possibly can. And this is what we do is the 100% drip. With that $525,000 invested into this, okay, you would have added about 4,000 additional shares by taking all of that distribution money and pouring it back into it. Your ending balance would have been a positive $34,000 additional for the net portfolio growth, which achieved that 7.19%. Okay, so your total return came in at 6.47 percentage point. Now, by dripping every cent, the investor adds that 4,000 shares to the position. While not a blowing the doors off for 2025, the strategy successfully turns a share price decline into a positive return. Okay, not the 15% that we targeted, not the 16% that they advertise in their yield, but a true hardcore 6.4% gain by dripping all of the funds. Now, if we're going to be a split, a 50-50 split, which in a lot of cases, when you're getting into high risk funds or higher level funds, is really where I always suggest people go into it. This is a balance. You're getting immediate income with some principal preservation. Now, who uses this? These are people who are either A, getting close to retirement. When I say close, so it's within probably 1 to 2 years, or people who are just got into retirement 1 to 2 years. They're going to be on a 50-50 split. Okay, you're going to take some income, you're going to need some immediate money, but you're also going to keep growing your account until you really get your retirement understanding of where you're at with it. Now, I will tell you right now, I'll take a quick little break. At the end of the video, I'll post a video that we just did about retirement, preparing yourself for retirement. Are you ready to go? And it's a great question, 6 questions to answer. In about 10 minutes, you can tell yourself if you're ready to retire or not. And this is why I say strategy 2 comes for those type of people, is that you're starting to take income. You're starting to live off your investments, but you're still growing your investments. Okay, so you would have taken $36,000 off the table, put that in your pocket, go spend it, do what you want to do. You would have gained another 1,900 shares. Okay, so this is going to help, that price decline. That's going to help what I call the total engine to help develop it. Your net portfolio balance impact, though, is down about $3,000. Okay, so you're going to be off a little bit because of $3,000, but you also took $36,000 put in your pocket. So that's why I say it's negligible of, that it's a big change, but it kept you balanced. That's why that 50-50 works so well in pre-retirement. Now, if you are a person like myself who is 10 years into retirement and you need every dollar you need to spend to pay your bills, to do everything that you need to do to live off of your income, you're going to be in strategy number 3. And this is, this is the point where you're taking all the money, zero drip, zero anything. So this is the zero drip reality. Now, I put this one up here because I want to make sure people understand it. The high cash yield masked the erosion. This is why I do these back tests. This is a reality check. This is what we're looking at moving forward. Okay, the total cash income, you would have had $70,000 to live on. Now, most people, the averages I see, and I'm not saying this everyone, but the majority of people we do talk about, $70,000 would be probably enough money to retire on and live comfortably over the past 12 months. But you have to remember off of this, the principal loss, you lost $38,000 of your nest egg has gone away. So the way I explain this to a lot of people is, yes, you got $70,000 from your investment. $38,000 of that, though, is your own money that came back to you. Okay, so you really only generated $32,000 from your account, and $38,000 came from the principal loss. Okay, yes, you're getting the dividends, but you have principal loss across the board. This is why we say your total return was down to 6.28%. So, it's a high income that's misleading you. You're looking at $70,000. Oh my God, this is a great account. I'm getting 15% return, technically 16% yield return. This is why we don't yield chase. The principal erosion occurs without the reinvestment. The fund underperformed strategy number 1 by 6.47%. So I really say it's disappointing results for a strong market year. We had a good, decent season until we had the April drop off, and then we had a little adjustment in November And now we're, where we're at today with everything going on in the politics. So the fund didn't really perform as well as everyone thought it was going to. So this is something to make sure you understand that if you're what category you're in. If you're in category one, not a bad fund. You're getting about 6.5%. Category two, you're basically breaking even. And if you're sucking all the money off and using it to live off of thinking you're getting the 15 or 16% return reality check, you're really not. You gotta watch your total returns. So the final verdict, total return versus nominal income. Again, I keep telling the same story over and over. Income is great, but total return is king. Personal finance is personal, but math is the objective. I tell this to everybody. I tell it to my kids. I tell it to people I talk to. Retirement finances, everything together is about really simple math. Basic math. If you can find the general fund average about 12%, Omaha is only getting you 6 when you're looking at total returns. Okay, retirement risk, a drop of 25 cents to 23 cents per share is significant pay cut. So if every month you're relying on a certain dollar amount, this one's going to have some fluctuations. Okay, you're going to be in and out, different pricing. So I suggest people always, if this is going to be one of these things, I would cut your dividend down to about 20 cents. Anything over 20 cents, you take that money, reinvest it back into it. It's not the 50-50 program, but at least you're reinvesting something back into your future. And now you struggle and say, hey, I'm living off of 20 cents per share. Okay, this is suitable for the Berkshire fans who prioritize monthly checks over maximum capital growth. If you put this up against head to head against a fund that Berkshire puts out there, income, night and day difference because they don't pay that. He doesn't believe in dividends. He reinvests everything and sell off when he needs money. The market contrast is 6.84% is disappointing in a strong 2025 year, but be wary of the income hype of that advertising 15%. So you always got to take a look when they advertise at 15%, yields look great. What's the total return? Ask yourself. And don't be afraid. Don't have that FOMO, a fear of missing out. Don't be afraid. Oh, I missed that train. I missed this train. Every train comes back to the station. Okay? So don't be afraid that waiting that 6, 8, 12 months before jumping into a fund just because, it's exciting, it's new. No, just wait. And this will tell you down the road, is this a good fund or not good fund? So is it part for a retirement? I really, I'm going to say this, guys, is I'm not real, we've talked about this before about retirement. I'm not real positive about it now after seeing what it's done for after 12 full months. I still own it. I will continue to own it. Why? Because, I have other things invested that I can actually do a 50-50 blend on this and have, add $30,000 to my portfolio. I can work with these numbers. But I can't say everyone else can. If you're 100% retiring on this, absolutely not. So you need a nice mixed blend, and that's what I like about the holdings. It has a lot of self-secured holdings across the board. But you know what? Let me know your comments. Let me know what you think. This is a good account, bad account, mediocre. You own it, don't own it. I'd love to hear from you. Leave a comment down below. Don't be afraid to hit that like button.
Thank you for watching. Press the